The American dream of car ownership has turned into a financial nightmare for millions of Americans. Vehicle repossessions have surged to a shocking 1.73 million in 2024 alone, the highest level since the Great Recession. What we're witnessing isn't just a blip, it's a full-blown crisis that's revealing deep cracks in our economic foundation. Last year, auto loan defaults reached an alarming 2,332,837 cases, exceeding levels seen during the peak of the 2008 financial crisis. Today, we're diving deep into America's auto loan crisis, a story that affects not just car owners, but home buyers, investors, and the broader economy. We'll break down exactly how we got here, what the numbers tell us, and what this means for your financial future. The scale of the problem. Let's start with the cold, hard facts about this growing crisis. According to data from Cox Automotive, vehicle repossessions surged by 16% in 2024 compared to the previous year and a staggering 43% compared to 2022. In total, approximately 1.73 million vehicles were seized last year, reaching levels not seen since 2009 during the financial crisis aftermath. The repossession rate has climbed to 2.3%, while the auto loan default rate hit 3.13% in 2024, the highest since 2011. For context, during the Great Recession, the default rate peaked at 4.12% in 2009. What's particularly alarming is that these numbers aren't improving. In July 2025, CFPB data revealed that the rate of vehicle repossessions in the United States had exceeded pre-pandemic levels, with nearly 0.75% of all outstanding vehicle loans assigned for repossession, a 22.5% increase from December 2019. Why is this happening now? Several key factors have converged to create this perfect storm in the auto market. 1. Skyrocketing vehicle prices. Both new and used car prices soared during and after the pandemic due to supply chain disruptions, chip shortages, and increased demand. According to Edmunds, the average transaction price for new vehicles hit record highs in 2023 and 2024, pushing buyers to take out larger loans than ever before. While prices have started to cool slightly in 2025, the damage has already been done. Millions of consumers are now saddled with auto loans that were based on peak pricing. 2. Rising interest rates. The Federal Reserve's aggressive campaign to combat inflation pushed auto loan interest rates to painful levels. As of early 2025, the average interest rate for new vehicle loans stands at 7.3%, while used car loans have reached a punishing 10.9%. To put this in perspective, a buyer financing a $35,000 vehicle over 60 months at today's rates is paying thousands more in interest than they would have just 3 years ago. 3. Inflation's ongoing impact. While headline inflation has moderated somewhat, the cumulative effect of years of rising prices for essentials like food, housing, and healthcare has left many households with little financial cushion to absorb their car payments. 4. Changes in lending practices. Following the pandemic, we saw a significant shift in who was originating auto loans. Banks, which historically held about 35% of loans outstanding, appeared to tighten standards and reduce their auto lending in 2022 and 23. This created a vacuum that was filled by credit unions and finance companies, particularly independent finance companies that focus on riskier segments of the population. The repossession and its impact. For those unfamiliar with how repossessions work, here's a sobering reality. In many states, lenders can begin the repossession process immediately after your first missed payment. While some states require a grace period of up to 20 days, the protection for consumers is minimal. What many borrowers don't realize is that even after repossession, their financial nightmare isn't over. According to Consumer Financial Protection Bureau data, the average outstanding balance for consumers who still owed money after repossession increased from over $10,000 in December 2019 to more than $11,000 by the end of 2024. This is because repossessed vehicles are typically sold at auction for far less than their market value, and lenders only receive about 30% of the value of a repossessed vehicle after it's sold. The remaining balance plus repossession fees still falls on the borrower's shoulders. Impact on the housing market. The auto loan crisis isn't happening in isolation. It's sending ripple effects throughout the entire economy, particularly in the real estate sector. Here's why home buyers and property investors should be paying close attention. 1. Credit score damage. As auto defaults increase, credit scores take significant hits, leading to fewer qualified home buyers. A repossession can remain on a credit report for 7 years, making it substantially more difficult to qualify for a mortgage during that period. 2. Decreased buying power. Households struggling with auto loan payments have less disposable income available for saving towards a down payment. This directly impacts their ability to enter the housing market or upgrade from their current homes. 3. Lending standards tightening. Just as we've seen lenders tightening standards for auto loans, we're beginning to see similar cautions in the mortgage market. Access to auto credit is now 23% harder to obtain than the historical 15-year average, according to data from Cox Automotive, a warning sign that mortgage credit may soon follow suit. 4. Foreclosure risk. There's mounting evidence suggesting a correlation between auto loan defaults and mortgage defaults. As industry expert Glenn Weinberg from Fairview Commercial Lending notes, there likely will be a corresponding increase in foreclosures in the coming year or so, as borrowers who benefit from artificially inflated credit scores during the pandemic revert to previous repayment behaviors. 5. Investment property considerations. For real estate investors, these trends suggest potential opportunities and risks. While distressed properties may become more available, financing those investments could become more challenging as credit markets tighten. Implications for investors. The auto loan crisis creates both challenges and opportunities for different types of investors. Stock market investors. The financial services sector, particularly companies heavily exposed to auto loans, warrants careful scrutiny. Publicly traded auto lenders, banks with large auto loan portfolios, and even car manufacturers that rely on financing divisions for profitability may face headwinds as defaults continue to rise. Bond market investors. Auto loan asset-backed securities, ABS, have generally been considered relatively safe investments. However, the rising delinquency rates, especially in subprime auto loan securities, present new risks. According to Fitch Ratings, the 60-plus day delinquency rate of subprime auto loans rose to 6.15% in December 2024, a record high in data tracking back to the early 90s. Real estate investors. As mentioned earlier, the spillover effects into housing create both risks and potential buying opportunities. Investors with strong cash positions may find increasing opportunities in markets where credit-challenged buyers are forced to remain renters longer than planned. Private lenders and hard money. With traditional financing becoming more difficult to obtain, private lending and hard money loans may see increased demand, though with correspondingly higher risks. Savvy investors in this space are already adjusting their underwriting standards accordingly. What this means for different demographics. The impact of the auto loan crisis isn't being felt equally across all segments of society. First-time homebuyers. This group faces perhaps the most significant challenge. Already contending with high home prices and mortgage rates, the additional burden of auto loan stress further reduces their ability to save for down payments and qualify for mortgages. Middle-income families. For families earning between $50,000 and $100,000 annually, the auto loan crisis represents a serious threat to financial stability. Many have stressed their budgets to purchase vehicles at peak prices, leaving little margin for unexpected expenses or economic shock. Investors and retirees. Fixed income investors face dual concerns: direct exposure to auto loan asset-backed securities in their portfolios and broader economic impacts that could affect other investments. Retirees on fixed incomes who need vehicle replacements face difficult choices in this high-cost, high-interest environment. Signs of trouble and preventative measures. For viewers concerned about their own financial situation, here are key warning signs of auto loan trouble. 1. You're struggling to make payments on time. 2. Your car payment exceeds 15% of your monthly take-home pay. 3. You owe more on your auto loan than the actual value of the car. Negative equity. 4. You're living with the fear of vehicle repossession. And 5. You're being contacted by collection agencies regarding auto loan payments. If you recognize these warning signs, consider these proactive steps. Contact your lender before missing payments. Many lenders offer hardship programs that can temporarily reduce or defer payments. Proactive communication is essential. Options disappear quickly once you're in default. Consider refinancing. If your credit score has improved since taking out your loan, you might qualify for a lower interest rate. According to Bankrate Chief Financial Analyst Greg McBride, rates are expected to ease for most borrowers in 2025, though the high-rate environment will persist for bad credit borrowers. Build an emergency fund. Even a small emergency fund can provide a buffer during temporary financial difficulties. Aim to cover at least 3 auto payments to give yourself breathing room during hardships. Review your budget. Make a comprehensive assessment of income and expenses to ensure your budget accounts for all necessary payments, including your car loan. Look for areas to cut back to prioritize essential payments. The outlook for 2025 and beyond. What should we expect going forward? Industry forecasts suggest mixed signals. On one hand, auto loan rates are expected to moderate slightly in 2025 according to Bankrate, which could provide some relief for new borrowers. However, the volume of car and truck repossessions in 2025 is projected to rise or hold steady at approximately 1.8 million vehicles, according to projections from CU Repossession. This suggests the crisis is far from over. Federal Reserve data indicates that delinquency rates on auto loans rose substantially to above pre-pandemic levels by the end of 2024, with trends suggesting continued pressure on borrowers into 2025. Most concerning is that the increase in delinquencies is mainly concentrated in auto loans originated since 2022, precisely when vehicle prices and interest rates were highest. This suggests that the problem may worsen before it improves as these newer loans age. Economic indicators to watch. For those trying to anticipate where this crisis is headed, keep an eye on these key indicators. 1. Unemployment rates. Historically, auto loan performance is closely tied to employment trends. 2. Interest rate movements. Any Federal Reserve decisions to cut rates could provide relief for variable rate loans and new borrowers. 3. Used car price indices. Further declines in used vehicle values would exacerbate negative equity problems for current borrowers. 4. Consumer confidence reports. These provide early warning signs of broader economic stress. And 5. Credit availability indices. Tightening standards can accelerate the cycle of defaults. Conclusion and action steps. The auto loan crisis serves as a warning signal for the broader economy. While some analysts compare current conditions to the early stages of the 2008 financial crisis, there are important differences, particularly in the overall health of the banking system and housing market. Nevertheless, the situation demands attention from consumers, investors, and policymakers alike. The spillover effects into housing and other sectors of the economy could be substantial if the trends continue. For viewers concerned about protecting themselves, consider these key takeaways. 1. For current auto loan holders, review your loan terms, consider refinancing if possible, and communicate proactively with lenders if you anticipate payment difficulties. 2. Prospective car buyers. Consider less expensive vehicles, larger down payments, and shorter loan terms to avoid negative equity. 3. For home buyers. Work on improving or maintaining your credit score and save aggressively for larger down payments to offset potentially tighter lending standards. 4. For investors. Diversify portfolios, scrutinize exposure to auto loans and related securities, and prepare for potential buying opportunities if markets deteriorate. The road ahead may be bumpy, but with proper planning and awareness, you can navigate these challenging economic conditions. Thanks for watching. Please like, subscribe, and share this video with others who might benefit from this information. And watch this one as well.